Well, I'm going to the city and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. It's a look back at what happened in the financial markets in the past week, and a look forward to what might happen in the next week. And hopefully, lots of great ideas and opportunities for you throughout this show. Well, the stock market waffled again this week. It's the third week in a row that we had mixed results, as simply the market bobbed up and down like a boat that's lost its anchor. Focuses clearly on Turkey and the chaos in the currency markets, but neither the bulls or bears could get any traction at all, and the markets overall, stock market at least, ended little changed. If you look away from the U.S. stocks, it's disturbing trends that continue in those markets. Commodity markets under a lot of pressure. Metals make new lows. Gold came down and tested that 1180 number that we talked about as a target, and certainly problems out of South America, out of South Africa is an issue there, because as their economy has problems, then they have to, their big export is gold, or one of the big ones, and they might have to actually sell those assets. So South Africa issues are leaning on the commodity markets also, as well as the threat of economies slowing down and some pretty bad looking stock markets there. Platinum, in fact, makes a 10-year low, and copper continues to be very weak. All of this indicating some potential for trouble. World stock markets look, well, absolutely horrible, and on Thursday we recorded a video in our stock sectors category of videos that looked at 15, 16 different world markets, and those stock markets are just looking terrible. And also, our projection on those is for problems into the fourth quarter, maybe declining sharply into November or December. So the world essentially went from kind of this quiet codependence into a period of more chaos. It was like, we'll create all the debt we can, I'll hold yours and you hold mine, and you can get away with that until all of a sudden some of the we cans start to come apart. You can print money for so long in this world of fiat and get a false sense of prosperity, and eventually the weak hands run into trouble, as we're seeing happen in so many areas of the world. It's crazy how this contagion moves so swiftly. China, Turkey, Venezuela, Argentina, South Africa, other areas of South America, Italy, a lot of the southern European countries. I mean, kind of bouncing from one to the other. And Turkey essentially did what the U.S. did. Bank stocks in Europe really taking a hit. And essentially they tell the banks, let's ignore what the bond market is telling us. The fact that all of this debt, like in Turkey, which has no value, because as their lira collapses, all of that, whatever intrinsic value there was, disappears, and a combination of weaker economy there, weaker currencies, and they just, now this week have said, let's ignore that. How long can investors get away with that? If you look back to what happened to the U.S. in 2008, 2009, it was a nightmare as things started to come apart then, and the U.S. did the same thing. They said, well, let's get rid of FASB 108, which essentially was the rule to the market. So we said, we know these things don't have any value. We're just going to tell the banks they don't have to mark them anymore to this declining values. And so the world didn't get to see the reality of some of those really collapsed prices. So Turkey's doing the same thing. It's all deceptiveness, all of that. How long will investors allow this deception to go on? We have, false economies when it's all based on this printed money and the fact that they believe that, debt equal assets. That certainly isn't the case, so we couldn't live our lives that way. So what do we have? False economies that's built on fiat money. We have false low interest rates. We get from all of that false levels of earnings and, of course, false levels of asset prices and false employment numbers that we're getting that are all based on these exceptionally low interest rates. False. Do you remember that Seinfeld episode when Elaine was talking to Jerry about their intimate moments that they had together? Fake, fake, fake. That's what she said, and that's essentially what we have. Fake when it comes to fiat money and central banks, giving us this sense of problem, a sense of stability when we really have inherent problems. And again, when you see what's going on in some of these emerging markets, developing countries that are built on this debt, and the rest of the world holding their debt, once things start to go bad, it really gets bad. I'm afraid for my kids and my grandkids when I look at this. In 2008-9, there was a reset starting, a purge. Well, we need that. We need a reset and a purge. We can't run the world this way under these false pretenses of what real growth is. In the meantime, the U.S. market is fine. It's holding on perfectly as this chaotic vortex is spinning around and seemingly not yet affecting the U.S. markets. I want you to watch that video that I recorded on Thursday, Stock Sectors on the World Markets and World Market Stock Market Conditions. To me, it looks like a disaster out there, and that the U.S. is simply this safe haven. U.S. stocks, however, I think the risk is growing, and this island of safety that we have been, well, basically, I think it's about to get flooded. I think that is telling you how I feel about the way this economies in the world are run and the risk that we're seeing out there looking at, well, charts all over the world and comparing that to the U.S. that just, I think, the investors haven't caught on yet. Let's take a look at what happened in the stock market this week as we look at the 60-minute chart of the S&P 500. And you can see that there was a big dip in the middle of the week, but then the market stabilized. The market got a little help from Apple during the end of the week, of course. Here you have the South African rand that crashed at that point, and that really put weight on gold. There were a lot of contagion fears. Italy bonds dropped. Then there was rumors here that in Turkey they were going to release Reverend Brunson. That proved to be erroneous, as we've seen Turkey really double down on that. Contagion hits Argentina, Brazil. Argentina raises rates to 45%, and the markets get hit here on Monday. Turkish Lira stabilizes overnight here on Tuesday, and we get a little bit of a lift as stability comes into the market there. Then again on Wednesday, contagion starts to hit again. World markets drop, led by all the emerging markets. European banks very weak on their Turkish exposure. Turkey hits back, raising tariffs on the U.S., doubling some of them, and they deny that Reverend Brunson release is coming, and U.S. tech stocks drop big. Tesla drops on an SEC subpoena. Then rumors or something came out here on Wednesday that Qatar was going to come to the rescue for Turkey with $15 billion, and that you can see helped the markets as we got a rally in there off of those sharp overnight lows. So the market did recover there on Wednesday. Thursday, China and U.S. agreed to low-level talks. You can see that right over there. That just simply means they're going to send a messenger boy over and see what they can talk about. It's so bogus. And then we got markets recovering overnight. Walmart and Cisco had good earnings. We got between those stocks and Apple, the Dow had the best week of all of the indexes, and Apple surge right in here on Thursday lifts the stock market. Then on Friday morning, the president comes out and with additional threats because of Brunson's failure for them to release Brunson. The lira drops, and then chip stocks took over and they started to drop overnight. Applied material earnings and declines in the chip group, and Tesla down 5% as the SEC opens an investigation. I've got more to say about that. And then Apple comes to the rescue. Apple rallied off some 10 points on Thursday and Friday before it started to back off a little bit, getting over 217, and it was truly Apple to the rescue that saved the market right there. So that is a look at what happened during the week, and you could see an early week plunge. We had talked about the S&P 500 getting down to about 2821. It got lower than that and then made that recovery. So that is a look at that 60-minute chart of the S&P 500 with the influences of what happened during the week. Stock market for the week, as we're here around midday. I'm recording this a little bit earlier in the day because any minute now we're going to start to hear the Chicago Air and Water Show practice starting, and there's no way I can soundproof from an F-16 Hornet buzzing my window here by the lake. So it's really gets really noisy. So I'm a little earlier than normal on doing this show right now. Stock market very mixed. S&P 500 up a fraction, Dow Jones Industrial Average up over 1%. The NASDAQ down a fraction, and the Russell moving about unchanged on the week. Interesting, the NASDAQ is down a fraction with Apple having this just tremendous week. It tells you what some of the other stocks are doing in the NASDAQ. Being held up by one stock right now, that could be some trouble. Bond market, 30-year up about a half point on the week. 10-year yields just nudging up a little bit as that yield curve just goes out a little bit. Dollar flat on the week, got a little volatile, moved up and then moved down. We had a target of about 97 in there, and it got within just a couple little ticks from the 97 area. Gold falls $33, silver 42 cents. As real fear out there comes about world economies and South Africa and demand, and gold stocks got absolutely wrecked out there as the GDX collapsed one day for one of the biggest percentages I've seen it drop in a long time. Oil down about $2 on the week also, as the commodity markets remain very weak. So we're going to look at a temporary bottom potentially when we look at the short-term view for the coming week. That's the opening segment, and we'll be right back looking at the best and worst stocks for the week. All right, for the best and worst stocks for the week, we're going to look at weekly charts. For those people that are new watching this show, we do cycle analysis, and very, very important that you get the sense for what we're doing when we look at these charts. They are the heartbeat of the market, the rhythm of the markets, and we look for these repeating patterns, and they have really strong messages. We look at multiple time frames. We're going to look really basically only at the weekly charts right now, which is really the core of what we look at. Follow me on Twitter at askSlim. Become a subscriber on YouTube. we put up this show and some other things, you like what we show you here, give us a thumbs up in there, because that helps us. And go to our website. You can see what our memberships are, and if you'd like half-price trials on our memberships, write me slim@askSlim.com. And money managers and traders, I have consulting packages, and I also have coaching packages for traders. So make sure you look at that on our website also. I happen to have an opening for October and November for traders, so you can look at that and decide if you want to be coached by me. All right, so now let's take a look at the best and worst for the week. Retail was just a giant winner this week. Well, we'll say that retail mostly was a giant winner, because when I get to the worst of the week, I'm going to show you some retail stocks that were not. But we're going to look at the best stock of the week right now, which is Walmart. So when you want to know why we had some good performance on some of the high caps, I mean, this was one of those. Cisco, Apple, them really helping the high cap index hold up there. Walmart up 9% on the week. It moves through that resistance zone. This has, you can see, a nice projection in here as it projects up to the 78.6%. The length of this rally and accelerating up through those resistances is important in here. And it says to me that this is likely not to be the peak. You'll probably try to get a little higher in there and then roll over. And then move higher again. This is a much improved pattern, and we're going to look for the potential for buying opportunities in this stock. Great earnings, and it moves up strongly, 9%. Nordstrom, which has threatened to go private, JWN, quite a number of times and has not been able to. This one jumps right into those fib extension numbers right over there, really showing you a lot of strength. Now, I want you to notice this is only 2 weeks off the lows. That's an important thing to be telling you, because when you're 2 weeks off the lows, you end up likely rallying more. As a matter of fact, it's hard to see any time period in here in rally phases where they rallied 2 weeks. They rallied for 2 months in a lot of them, or longer. So this is likely not the peak. We're going to be looking for a pullback in there. And they had a big beat in earnings. They guide up. Analysts raise their projections in there and their targets. And we're going to have to do the same thing with ours also as it gets up to those fib extensions and likely to give you some higher prices in Nordstrom. I guess the tax plan is bringing a lot of money into the hands of consumers, because consumer spending is strong right now, and you can see it in these results. Take a look here, and you can see that this is Tapestry. This stock has a strong 6.5% gain on the week. This is potentially a short-term top, and you can see as it rejects those levels up there, and then we have a buy zone projected right in here. Earnings strong. Analysts upgrade the stock. We want to avoid it right now, and this corrective period pulls back to maybe 49 sometime between now and mid-September. We think those are buying opportunities, and you'll note we have that labeled as a buy zone in there based on supports and what we call swing high, swing low analysis. So that is a look at three very strong stocks in the area of retail. CVS is the next one we're going to look at. And this is just great. You know, I've had some people write to me because I talked about CVS and this bullish base right in here, and that we thought it was going to get higher. Look, it gets right up into that target zone. It is also only 2 weeks into the advance, and 2 week advances off of important lows are unlikely to be the end of it. You can look in all of these right over here, 1 and 2 and 3. Those peaks were, well, 2 and 3 months into the rally. So we're not looking for any kind of a top in here, and we'll be raising our targets in there also. We loved it. Analysts love it, upgrading the stock now. And it's interesting because we think that Walgreens is a sell based on its patterns. Dick's, DKS up about 5% on the week, but we're looking for a decline in Dick's from this level and maybe coming down for about 3 or 4 more weeks. Just a little bit of a temporary dip in there, and what is also an improved pattern in DIX. We're going to look now at KMB as we jump into, well, different area of the consumer area, KMB. And this is an interesting one because it had a good earnings report and then it pulled back. And when I showed it, I said, you know, that pullback doesn't look to me like it's going to be it. Like it has another shot up in resistance. And sure enough, you could see that right here. Now it's getting long enough in the tooth here in this rally that we think it's going to stall in this resistance zone. And you could see our projection in there as we're looking for it to, you know, just give you a little more correction here into October. And then probably do a lot better later on after that. So this is no matter how much we think that the markets are in trouble, this is a more defensive stock, and that could be a stock that you know, money gets parked in. But again, we wouldn't buy it in this area. It's a major resistance area, up 7% on the week for Kimberly on a great performance. I want to look at Apple, and then I want to look at two more stocks that I think are interesting in that they were up, but they're bad. Take a look right over here. You could see Apple. It gets up to that 78.6 fib extension. Normally between the 78.6 and the 100 is a target zone. It wasn't our target zone. It just exists here on the charts, and I never thought it was going to get that high, but buybacks driving the stock up, and you could see this was a massive week in here. Last week it closes around 208. This week it gets as high as almost 218. So mostly that comes on Thursday and Friday, and we think it's rest time, and we're going to be looking for a decline in here under 207 back to where it came from, to that 23.6%, 3% gain on the week on these buybacks, and hits that target. And at this point we expect it to pull back. Full disclosure, I just bought puts when the stock was trading up around 217, and I've stayed out of it to this point. But at this point, when it hits that fib extension level, I think it's going to correct. So I did take a little bit of a short position there in Apple. Two stocks that gained this week I specifically want to show you because I want to talk about things that, you know, our opportunities, trading opportunities, not what just happened, but what is likely to happen that I think are good opportunities. Two stocks that had rallies in what I think are bad patterns, and those are selling opportunities, are Lockheed Martin and Seagate. We're going to look at LMT as the first one in here, and this, of course, in the defense category, moved up into a sell zone, and in a pattern that we think is a problem. So you'll note in here that, you know, it had that classic M top right up over there, and I also want you to see these green arrows here. You see those are showing you the upward cyclical configurations, higher highs, higher lows. That shows you the trend as it essentially moves up the 13-week moving average. Then it broke down and gave you that big engulfing and completed this pattern right where it should have. In other words, the cycle brackets that are right here in the bottom, you know, they give you an indication of when the timing is for the lows to occur. But when you get a negative configuration, you get a high probability of failure in these sell zones right over here, and then decline to the, well, mid-November period is where this points out to. This stock is up 4% on the week. I think it's a screaming short, and I think you're going to see it move down again below the 290 level. That's stock trading at 325 right now, 10% or so drop, and we think that is a high probability short side trade. Seagate is the next one we're going to look at, and there's another one for you. You could see the head and shoulders top that formed in there. This is the major support zones in there. It tickled it right there, but it's in a negative pattern that points to a decline through around October 1st. So that says to us that rallies in here are likely to be sells, and we're getting a rally this week. Like I said, up about 4% on the week, and I think that Seagate in the technology sector, and technology is starting to get weighed on, especially stuff I'm going to show you in the semiconductor category. So we think that Seagate is a reasonable short. It's trading at 53.75 right now. And I think it's going to head lower to around 47. So again, that's something over a 10% decline. I think it's a high probability into September, and I think it's a worthy trade. Of course, I never give recommendations. I simply just show you the analysis and let you make it fit into what your own trading style looks like. That's it for the best of the week, and now I'm going to show you the worst. All right, for the worst of the week, got a number to look at here. It's going to be a little longer segment than we looked at for the best of the week. There were more stocks that looked bad. Interesting. So we're going to go back into the retail segment because that was the best of the week, and now we're looking at some stocks that are in this category that are also the worst of the week. So it tells you how mixed the group is. Maybe it's not all about the consumer spending helping everybody. As a matter of fact, there's some stocks going broke in this, and I'll talk about that in a moment. But here is Dillard's, DDS, and you can see that big perfect top that showed up in there. There was that evening star pattern right there, and that called the cyclical top. Often you will get candlestick warnings of cyclical tops and bottoms. Here was your dark cloud cover on that one. Here's your morning star at the bottom. Here's your morning star at the minor bottom. And this one I didn't even label. That's a morning star also. And now we have this downward resumption, and it looks like it's really in a problem area. If you look here, the low is projected out to November. That's November 5th right there approximately, and that's the declining phase. So were you to get a rally in there, I think it would be falling again down to under 67. So again, we're looking at some 10% decline from this level right now. This stock earnings beat, but their comps were a big disappointment, and that's why the stock went down. Macy's had a similar problem. As you could see right in here, look at that absolute gorgeous cyclicality that you can see in there. We actually have two cycles in there for you to see. That blue one right over here, that's these blue lines right in here showing you the dominant pattern. You know, I had some people writing me about this pattern, you know, looking strong, and I said, you know, it doesn't to me because it's likely to correct down into September, and you could see that as it pulls back into the support zone. A very clear M top in there and another month of downside risk in here. See that 34-week moving average coming up that gave it support there, coming up right over here towards this bottom. That's around $33. So I would not be a bit surprised to see $33 in Macy's, down 7% on the week on really poor same-store sale comparisons, and that was bad. Talking about bad, it was a couple of years ago that I started to talk about JCPenney, which was $14, and Sears was also trading much, much higher, and I said, these stocks have got an existential threat. I thought they were headed down to $2 at the time, and that bankruptcy was a possibility for these companies. And, well, they haven't gone bankrupt yet, but both stocks are annihilated. Sears trades down to $130, JCPenney down to about $168. That's $1.68, and they're down over 30% on the week. Both of them in bad shape. JCPenney simply had horrible earnings and big loss, way below revenues. Their financial demands are going to be enormous, and at some point in here, we're going to hear about the end, if we're not at the beginning of the end now, for these really dinosaur brick-and-mortar companies that just haven't kept up in this online world. So that's the discussion about retail. We're going to look at a couple stocks in the energy category right now. As the oil market moved down, the energy markets were weak. Two of the worst were in the drilling category. These stocks were in declining phases and the final parts of declining phases, and have broken down through some support even. Take a look here at RIG. This is Transocean. And again, you could see the cyclical patterns in there that are just very clear. See, this dark black line is the cycle bracket, the larger dominant pattern for RIG. We have that labeled. And this right over here is the OIH. So we put in there and overlay that as a comparison to the drillers. And you can see in here this declining nested area right over here is often the period of greatest risk. You could see our projection is it's going to make a bottom in here, and that it's soon to have a bounce. And it's still a bullish pattern, so we would expect the bounce to be fairly strong and also to happen fairly soon. So big decline, 14% on the week in Transocean. Diamond Offshore looked pretty identical, doesn't it? Amazing how these patterns work, except that its cycle patterns are much closer to the OIH pattern, as you can see right in there. They're almost in perfect synchronicity, and again, a bottom due as it approaches this 78.6%. And we think that, you know, if we get a bounce in the oil market, these things will get a bounce. And I think they're, for aggressive traders, they are reasonable places to nibble on long positions for bounces, for some pretty good bounces maybe. Easily Diamond Offshore could get up to that 34-week moving average, which is near $18. That would be about a $2 gain in there, and that's a big gain on a $16 stock. So that has a pretty good chance at bottoming and giving you some decent bounce. So, you know, worst of the week sometimes offer the best opportunities. Now we'll take a look at Tesla. I mean, this is a sad situation. As Elon Musk essentially jumped the shark. You know what show Jump the Shark came from? Well, essentially what that was from Happy Days, when the Fonz, for some reason, wanted to create a distraction and made believe he was jumping a shark when he was skiing. That's how I believe I understand the story. And so it's about creating a distraction, and that's essentially what Elon Musk must have tried to do, as the Tesla stock had soared on his now very famous tweet of a potential taking the company private at $4.20, $420. $4.20. Hope that's not a Freudian slip. And then the SEC has now come after him. They've subpoenaed the company, and the report that's out today essentially says that they are examining whether or not that the intent was to hurt the shorts or to cover up that there are production problems. And the last part of that is that analysts have come out now and warned that the Model 3 margins may be worse than expected. All of that saw the stock go from some 290 all the way up to almost 390, and now all the way back down to 308, as you see this absolutely wild chart right over here. So there's a look at the Tesla move in there, and you can see this big red zone. We had it projected to fall down to 310, which it got lower than that, and then targeted at the 272. Excuse me, and then that news came out, and now it looks like 272 is reasonable in here. That's the 78.6% right over there, and the low of this pattern is not due until October. So if you get a rally in here, it's going to be just simply some shorts covering again. The shorts that covered are probably not happy right now, and they're going to get on board on some whatever happens legally on Tesla. This is just a nightmare when you look at that, and it's been an unbelievable trader if you could get on this. The problem is when it was trading up to 385, I looked at it actually and said, boy, this is the spot. And of course it was hard to borrow, so couldn't short the stock, and that kind of was took away the play. So that is a look at Tesla, and you could see it looks just unbelievably bad, and I think the news is going to get worse in there. So you can get a few minutes of reprieve on the upside. I think it's a shorting opportunity. Semiconductors are the next group that we're going to look at. They're having a rough time here. One of maybe the big problem is, semiconductor industry is a commodity industry. So when there is a lot of supply out there and DRAM prices or flash memory prices start to decline, these stocks do not do well. They did really well as they were being led up by the blockchain Bitcoin craze, but of course that bubble has popped, and we're likely to see a huge shakeout in there. 1,600 cryptocurrencies out there. We're not going to have, at some point we're going to have 100 or less of them. So the whole blockchain craze is likely to still be out there at some point. That's down the road, but cryptocurrencies, I think, are the nightmare is just starting for them. So we're going to take a look here at I got off on a tangent there, didn't I? We're going to look at Cree, C-R-E-E, which is a semiconductor, and also they make light bulbs and stuff like that. So you can see in here that magnificent double top, the beautiful upward pattern, the support zones that, based on the swing high, swing low analysis, were very good. And now we've gotten down to the support zone again. There's one problem, and that is that big engulfing double top. And the projection based on this cycle pattern says a decline out to December. Boy, that's no good. And so earnings on that, they missed, and we think that what was a good pattern is now turning over. We never loved the stock because of valuation. There's a forward PE on there right now of about 88, and it's an exceptionally expensive stock, and I think that you're seeing what's going on, and when things have too much value and they don't make their numbers, they're in trouble. So this one, earnings missed, and it's just starting the decline, and I think it's going to last for a while. So that stock down sharply on the week, as you could see. Applied Materials also down, and this is a bad pattern. Earnings about in line. Their guidance was real weak. This is a breakdown, down 9% on the week. And this breakdown right in here, I can explain that to you pretty well. You could see bullish pattern, bullish pattern, bullish pattern. A negatively configured pattern that you could see right in here, the declining phase, the rally phase, and a breakdown so early right there. That decline points to a decline out into November. You see our target right over there is down to that fib extension, about $38. This stock is ugly. It has a high probability of moving sharply lower. This rally did not quite get to our sell zone, which annoys me, and now it's in bad shape. So Applied Materials in this semiconductor group looking just crappy. Now take a look here at Micron. We saw this negative pattern forming in here, and you had that top formation right there. Sadly, this is on our best for the year. It's still up for the year, and it was up monstrously. It was up from 43 to 65. It had a 50% gain, and now it's given most of that up. It's breaking underneath that key 34-week support this week. What do you think about that? Support. Perfect, support, perfect, support, perfect, and now perfect breakdown. This decline here looks like it goes into September and then likely getting a bounce, but you can we have to lower our projections on here because you can see it got there already down near this low right over there, and this one is going to be worse. So this one has had good upward revision in earnings, and the PE is just incredibly low. but this is like a value trap. I mean, it's like all of a sudden a commodity industry, they're projecting a lot lower prices, and this is not good at all. And with Applied Materials coming apart and some of these other ones in the group not looking great, that gives you some picture of some problems there. And the last group that we're going to look at are the metals and materials. Take a look at gold, Gold Corp, GG. This is pure ugliness. Now, our gold pattern, our longer-term pattern, points to a potential weakness in gold all the way out to December. This also points to December. See that GDX, that bottoms on 1223, this bottoms on 1216, and this declining mode that it's in right now has a long way to go. So yeah, you're going to get some bounces in here, but that is bad. GG down 10% on the week. Take a look at Newmont, NEM, and you'll see the same ugly pattern. This one points to a low in December. This is a different pattern that points to a low in February. So all of these things are just looking horrible. Now, you see this area right here at 36.59 when it broke that support. Well, I just showed you Applied Materials having done the same thing, and you get some awfully big downside accelerations when you do that, and you put on these negatively configured patterns. This one is just terrible, and it says that we're likely to go down for a long period of time. GDX, the same thing right in here, but there's your GDX potential bottom. Now this is down big on the week, 8%, and likely to get a bounce in here. And we're looking for gold to get a little bit of a bounce also. I'll show you that. And we think that would be temporary, though. This is your big gold pattern coming right over here, and look where that ends. December 16th. So all of this precious metals and stuff look terrible. Also in the materials category, Alcoa down 7%, and beware of a breakdown below 40 in there. Schnitzer down 15%, the steel company, as analysts downgrade that one, and that one looks like it's got 3 or 4 more weeks to go on the downside also. So these commodity stocks, they're just a nightmare. They're a disaster like we see the world stock markets looking too. Everyone but the U.S. market. So we'll see how long that can last. That's the worst stocks for the week, and I'm going to be right back to you and show you what our short-term view looks like for the coming week. All right, short-term view for the coming week. This is where I look at daily charts. We look for patterns that give us some indication of what we think is going to happen in price and in time. That's what cycle analysis is based on price and time. And we have, really, we strive to be about better than 60% correct overall on figuring out these shorter term patterns and figuring out the price levels and whether they're bullish or bearish or where we should short them or where we should buy them or where we expect them to trade to. We do all of that, and we rank ourselves based on that. And the last several weeks we've been phenomenal, 80, 90%, 70%. They've been great. This last week, though, 35%. We were really off. And how we were off was because we had expected that the commodity markets were going to get bounces this last week. Really bearish markets extend the length of declining phases, and that's what we saw happen. We saw it happen in light crude, we saw it happen in the gold market, and that was all in relation to a strong dollar that was out there. Well, that was until Thursday and Friday when the dollar pulled back. So these negative periods extended, and we expected the bounces to come, and that was wrong as far as that goes. We got the bond market correct in most of the pattern, but it rallied beyond the level we were looking for and didn't quite turn down as high, so we don't get much credit for that. And the dollar euro, we got that one right, and the stock market we got partially right. because we expected a small down week. It was a mixed week that we had in here. We expected it to trade down, which it did. It tested the numbers we expected, but didn't stay down there. So it's, we got that mostly right. We only get about 35% credit for what we're seeing in here. Let's take a look at what we think is going to happen for the next week. So here's the light crude market. That's that extension on the downside that we were expecting, that went beyond the date. You can see the note in here to our members that it looks like it's shifting, getting a little bit longer. That tends to be bearish when that happens. So we have this declining sell zone. We're looking for a rally into there, into that lower resistance area, testing 66.80 to 67.60. That would be about a $1.80 bounce from where it is right now, and then we think, as you can see, that it doesn't hold and moves down starting in a couple of weeks. So if we get a decline underneath this level, about 63.70 or so, that's going to be a really negative message. I think it's the highest probability they're going to try to rally, but overall this all exists in a pattern that looks pretty bad for oil in the intermediate term. So we expect the rally and then failure from that level. Note momentum has turned negative again in here, and that's that red arrow right over there, and that slim ribbon is telling you of the selling that came in, and that's a negative picture. So negative picture, except for a bounce into that sell zone, and that's what we want to do, is sell it if it gets there. That's a look at light crude. The next one we're going to look at is the dollar. So we're going to look at a $ DXY. This certainly strong. What we expected was that it would continue rising, and the momentum was up, and it's still up, as you could see. Our target was 97, and it practically hit 97. You could see that right over there. That's practically a tombstone or gravestone doji, which often signals a high, important high. So can see our projection right now is pointing for a lower week. We think it might chop around in there a little bit, but over the next week and a half, small down is what we're really looking for. Modest correction down to 90. The middle of this zone right over here is around 95.60. That's about the target that we look for it to test, and that gives gold a little reprieve, right? If you get the dollar pulling back, and we would say that's not a lot of trading opportunity when we look at that, because we think it's going to be pretty much tight range there. And almost everything we're looking at right now looks like tight range, except for that light crude trade that we looked at. If it gets up to that sell level, we think that could be a really good trade. So we'll look for small down here in the dollar. The opposite of that is the euro currency, where we're going to look for small up. And it's trying to bottom right there. You could see that doji 113.30 looks like the worst we're going to see for a while. So we'll look for just a narrow week in here. And again, momentum opposite the dollar is down, and we think that's an important sell zone around 115.12. We don't expect it to be able to do much better than that right now. So here we are, 114.33. 115.12 is not very far, and we don't think it'll do much better than that. The next thing we're going to look at is the gold market, which got hammered. And you can see in here all of our gold cycles. They're, to some people that say this is a mess. Somebody once called my charts dirty. I hated that. And to us, it's, and especially the people that are students of psychoanalysis, it's very clear. I want you to look clearly way up in the top left of the chart, where the slim ribbon turned negative right there. That is an important level. That was 1340 on gold, and it falls all the way to 1167 this week in all of this period of negative momentum. Note the resistance zones that were put in there all the way down as each of the minor cycles developed those, and that was the sell zones. And now we're in this place where it should be getting a bounce, and we're going to look for gold to get up here to about 1208 right there, and we'll call this a short-term bottoming area, without a bottom having been confirmed. There's just not a lot there. And we would say that that is a selling opportunity coming with the potential of getting up to 1208. That's not a very big rally that we're looking for in there. Silver looks worse than this, and this looks bad, believe me. Next thing we're going to look at is the bond market. And this is the ZBs. That's what we look at. It did better than we expected. Now, we did expect a rally that it would, get up to 144.21 and then pull down. So this was Monday right over here. It did that, 144.27, and then pulled down. So we were close on that, right? But then the buying came in again as these world currency markets got really nervous. And that brought the bids in again. And there's a flight to safety going on right now. One of my members shared with me the TLT chart. I think I'll share that with our members going down the road in it for the intermediate patterns. And it really points to the fact that bonds still have some time to rally in here. As the U.S. remains a safe haven. So this you could see as a pattern that looks for a little bit of a dip and then rallying again. Then this bigger pattern here comes into play. We're going to have to see how that works out. So we're going to look this week for a minor dip, 143.28 to 143.15, and then moving up again. This rising support, that minor support, we would consider that for aggressive traders to be a buy zone. And for those people that got short based on the fact that we had seen a stronger potential downside move in here for traders, that would be a cover zone if we did get the decline into that area we expected. The momentum was negative in here, and now it's turning positive, which is a good reason to say that we don't expect much in the way of a decline. Excuse me while I get a drink. So that is a look at the bond market that overall has got a much stronger look to it. Now we're going to talk about the stock market. Well, we talked about the stock market a lot already today, with the stock market managing to hold strongly in this whirlwind that's going on of chaos in the rest of the world. And certainly the action in Apple has helped. Now what we have is the market having moved lower, almost breaking down, and then having this couple of days where it's moved strongly up again. We think that the likelihood of it maintaining this upward move is low based on the patterns that we're looking at. So there are these repeating cycles in here that you can see right there. That is the Dow cycle. It's 21 bars. You can see that right there. This cycle right over here is the S&P 500. It's 20 bars. What that means is that you get a low approximately every 21 days, and these patterns have been recurring for quite a long period of time. You can see in here 22 days right here. That was a shorter one, 17 days. This was a longer one at 22 days. This one right over here, you can barely see that, was 21. Let me blow that up. You can see the 21 right there. And where are we right now? Well, we're at 11 right there. So that low, which almost broke down in the 11th day, we're now 13 days off that last low. The probabilities of it turning down again are very high when I look at that. And you can see that we, have this projected in a way that it's turned down already, and this island that's right over there in those fib extensions is going to be the peak. So right now, these couple of days we've gotten a lift, but we wouldn't be surprised if it turned down again in a significant way. If it broke out above that to a higher high over that 2863 level, that would be a very unusual condition, and of course anything can happen. But we think the odds are very high that the rally that we're seeing now right there is going to fail. We're going to look for a decline this week, and we're looking for a decline through sometime around midweek or Thursday to test those lows right around the 2800 to 2810 area, and then getting into some kind of a downward chop. Notice right over there where we have this little message of the risk increasing out there. That is in September, where we think the risks for the market are much higher. Right now they're kind of choppy, but then the risks really go up right at that point. So that is a look at the S&P 500. We're going to look for a small down weekend here as the markets still continue to resist the negative news that's out there everywhere. All right, so that's it. That is Market Week for the week. I hope there was some great information for you. I hope that you write to me. Let me know what was of value to you. Let me know what information about our content that you would like to find out about, whether it be about our memberships or about coaching or consulting for hedge funds, and be glad to send you all the information that we can. I want you to be so careful because it is so crazy out there, and we're always wishing you great trading.
Well, I'm going to the city and I'm gonna do a city show. And I know all my fans wanna learn how to make some dough. I've been